Accounting 101, you learned the basics of accounting. You learned about the different types of accounts, whether it's an asset, liability, or an equity account. You learned the basics of your debits and credits and how all of that information goes together to create your financial statements. So now we're going to begin to shift into looking at managerial type accounting. And in managerial accounting, we're using our financial accounting information to help make decisions for our company. We're looking at how is our company doing today? How do we plan for tomorrow? How are we doing compared to our competitors? And we're going to be doing that by looking at how do you analyze your financial statements. So now that we have our financial statements, how can we use them to help make decisions for our company? So when we're doing a financial statement analysis, we're looking at the finances of our company and using our basic financial statements to understand where the company is and how we can get it to where it needs to be. So when we're analyzing our statements, it helps reduce uncertainty, because uncertainty is generally caused by not having an understanding of where you are today and where you want to be. We also can apply certain analytical tools that we're going to look at to help understand where we're at. And we're doing this by helping to transform the data. And we're doing that by looking at ratios or different types of financial statement analysis that we'll look at as we move through the next couple slides. So financial statement analysis, the basic reason that we perform these analyses is in order to help users make better decisions. We're really going to define different types of users in this course. We have our internal users and we have external users. Internal users are people internal to the company who help make decisions for the company. So that's generally going to be our upper level managers, officers of the company. That would be people like the CEO or the chief operating officer, the higher level officers of a company, and people like your internal auditors. These internal users are the focus of managerial accounting. Managerial accounting is using our accounting information to help make decisions on how a company is run. And so those are the information that our internal users use. Now, external users, on the other hand, are people who are external to the company. Or they could be lower level employees who are simply not decision makers. They're also considered external, even though they're employed by the company. So your typical external users are your shareholders. That's people who are looking at buying stock in your company or selling stock. Lenders, so this is banks and things, people who may lend you money. And customers. External users are not privy to all of the information that internal users have. On the other hand, external users only get the publicized information, and those are generally your basic financial statements. Internal users, on the other hand, they use managerial accounting information, and they use our basic financial accounting information, which is those basic financial statements. So let's look at what we're talking about when we are analyzing a company. Some of the main things that people are looking at when they're analyzing financial statements. People are looking at the liquidity of a company and the efficiency of a company. Liquidity means how close are your assets to cash. And this is important because it helps determine how risky a company is. Looking at efficiency, we're looking at how is a company using the assets that they have in their possession. Solvency. Solvency is very important because solvency talks about whether or not a company is able to pay their debts as they're coming due. If you are insolvent, the company is going to go bankrupt and it therefore will no longer be a company. So solvency is very important. Profitability. We're looking at, sure, you're making lots of revenue, but how are you controlling your expenses? No matter how much revenue you make, it's important to keep track of your expenses because even if you're making a lot of revenue, if it's too expensive to produce that revenue, you're not a profitable company. And then also we're looking at market prospects. This is looking at where a company is today and where they're wanting to move. Looking at competitors. How do we rank along with our competitors? If we're a profitable company, yes, we're profitable, but we're consistently below our competitors, whether it's in our quality or in our production of net income. If we're always below the market and below our competitors, over time we could begin to lose our market share and eventually become unprofitable, and then we may even begin to have solvency or liquidity issues. So some of the basic information that we need for our different analyses, you can see here we have our basic financial statements. That's our income statement, balance sheet, statement of stockholders' equity, or the statement of changes in retained earnings, either way, the statement of cash flows, and then finally the notes to financial statements. Now, number 5 here, that's not one of the typical things that you think of when you list off all of your financial statements. However, the notes to financial statements are very important. If you pick up any company's, their what they call a 10K, which is their filing for their yearly financial statements, the notes to the financial statements are going to be much more detailed and much longer than the actual financial statements. Your 4 financial statements may only take up 4 or 5 pages, 1 page per statement. But then the notes to financial statements, you could have anywhere from 20 notes or more, and they could be over 60 pages long in notes. So what are those notes? Those are simply going to be descriptions of some of the information that is within your financial statements. So for example, they're going to tell you about if you have different assets. They're going to tell you about how long is the life of those assets. They're going to give you more detailed information that backs up what is in your financial statements. So all of that information together is very important to have to be able to analyze a company. So some different standards for comparison. So when we're talking about comparing a company and analyzing it, what do we mean? What are we comparing it to? And there's many different things that we could compare to. We have intra-company standards or intra-company comparison, and this is where you're comparing one area of the company to another. Maybe you're comparing different departments, or if, for example, if you're a manufacturing company and you have many different lines that are producing the same item, you may compare how efficient line number 1 is as compared to line number 2 or number 3. Next, we would compare to our competitors. How is our company in comparison to those with which they compete? Industry benchmarks are very important because rather than simply looking at one competitor, we're comparing our company's results to the average of our industry or the average of our competitors. And then finally, we have our basic guidelines. And these are some of the things that you would have learned in Accounting 101 when you're looking and learning some of your basic ratios, for example, the quick ratio or the current ratio. There are certain standards that are considered acceptable for certain ratios. So you want to see how your company is doing as compared to that ratio. A couple different types of analyses that you can complete. You have a horizontal analysis, and this is where you're comparing how a company is doing over a course of time. It's called a horizontal analysis because you can think of it this way. If you want to compare how your company is doing from one year to the next, the basic way to do this is to line up, let's say we're looking at our balance sheet. Line up the balance sheet for 2011, and then in the next column have the balance sheet amounts for 2012, then 2013, and so on. And then you compare horizontally or from one year to the next to see how things are changing. A vertical analysis, on the other hand, we are looking at things within the same year. And so a vertical analysis, you're normally comparing a company's financial condition based on a specific based amount. So you're looking at things as a percentage. Typically, when you're looking at, for example, your balance sheet, you would be comparing different items as opposed to your total assets. So you would make a ratio. For example, we would look at our cash amount to total assets. So we would divide cash by total assets. If you're doing a vertical analysis of the income statement, typically your base amount is going to be your net income. So you might be comparing a certain type of expense to net income and making sure that that ratio is staying within whatever limits your company has determined to be appropriate. Finally, we have a ratio analysis, and this is where we're looking at how our company stands with specific ratios. We could be comparing it to whatever the ratio was for our same company in the past, or we could be comparing it to a general standard that says our current ratio should be a 2-to-1 ratio. Where do we stand today as compared to that general standard? We're going to go through more of these as we move forward, but just the basic understanding of what these are. Let's begin looking at some actual financial statement analyses, and we're going to begin looking at just some comparative statements. The first is going to be an example of what I mentioned before, a horizontal analysis. And this is when we line up all of our different balance sheet amounts or our income statement, whatever we're looking at, and compare across time. So we're looking horizontally. You'll see that when we look at the next couple slides. So when we're looking at these horizontal analyses, we can look at things in terms of a dollar change over an amount of time, or we can look at the percent change. So here, when we're looking at a dollar change, all you're doing is taking the amount for whatever specific account or item that you're looking at for the current period and subtracting whatever is your comparative period. So this gives us information about the dollar change. Another thing that's really helpful is looking at the change as a percentage, because sometimes when a company has had a lot of growth in a year, it's much better to look at things as a percent change rather than a dollar change. Because if a company's growing, $1 in the current year means a whole lot less than that did in previous years when the company was smaller. So we can look at it on a percentage basis and get to understand about just the overall percent changes. So let's look here. To calculate the percent change, this is just the same way that you would calculate any percent change. You would take the dollar change, and this is what we did on the previous page, but that's just simply the current year minus whatever your base year is, or the one that you're comparing it to, and that gives us the dollar change. And then divide that by the base period amount, and then multiply by 100 to get us to a percentage. So let's look here. We have an example of a horizontal analysis, and this is for the balance sheet. And this is where I was saying you can get an idea of why we call it a horizontal analysis. What we're doing is comparing horizontally the change in, for example, our cash and cash equivalents from 2012 to 2013. You can see here the dollar change is positive $3,513, which means we increased our cash and cash equivalents when we moved from 2012 to 2013. Then we can look at that as a percent change. The way we do that is simply take our dollar change here, which was $3,513, divide that by our base amount. This was the 2012 amount, or the old year amount. Multiply by 100, and we see there we had a 32.7% change. We can do the same thing. We can look at this for the income statement. Same thing. It doesn't matter if it's your income statement or your balance sheet. It's the same basic method. We're comparing horizontally. So you can see here we had a positive dollar change in the net sales, and then that gives us a 9.2% increase in sales year over year. So then, once you do these type of analyses, you can look at what's actually going on in the company. So let's just take a quick look. We already said that we saw an increase in our sales. Sales increased $14,000 and some change. But let's see what else happened. The cost of sales also increased. That increased by $18,760. So when I look at this, I could say I see something that could be a little problematic. We had a 9.2% change in net sales, which is a good thing, but we also had a large increase here in the cost of sales. So even though we were doing more sales, those sales were costing us more. So that's a good time to sit and ask, what's going on? Why are our costs increasing more quickly than our sales? You can look here, again, here's another example. Research and development increased significantly. And in this specific example, and if you read along in the book, the reason research and development was increasing is because they were putting a lot of time and effort into researching and developing new products. So research and development, you would hope that if we are putting money into creating new products, that we will see an increase in sales, and you see that. You can see here that research and development did increase more than sales, but that's typically what you'll see. An increase in research and development results in a change in sales, and it may not be a one-for-one result, you can see here, but we did have a positive correlation. Next, we can look at a trend analysis. In a trend analysis, we're just looking at an overall pattern. We're not necessarily comparing one year to the next, but we're looking at the pattern over time. So we come up with a trend percentage, and we get that by taking our analysis period amount, so that's whatever is the current period that we're trying to analyze, and divide that by the base period amount. Multiply that by 100. When you're doing a trend analysis, typically you're going to have information for multiple years, say 5 years or more, rather than just looking at 1 year compared to the next. So we're going to be comparing all of those years to whatever is our base period amount. So let's look at how that's actually done. You can see here we've got information from 2009 to 2013. Whatever is our oldest year is going to be our base year. So here 2009 is going to be our base year, and what we're doing is we want to see what has happened to these specific items that we're looking at over time. And we're not just comparing 2010 to 2009 or 2013 to 2009. We want to see the trend from one year to the next. So you do that by calculating the percent change of each item for each year compared to 2009. So for example, you can see here for net sales, let's just look at 2010 compared to 2009. We would take the change from year over year, the dollar amount change, $65,225 minus $42,905. Divide that by our base amount, that's $42,905, and that shows us that we had an increase of 152%. Then you would do the same for every year to get our trend analysis. And you'll notice here 2009, it's always going to be 100%, because if you took the change, there is no change. So we're not having to analyze anything for 2009. We're just going to say that those are all 100% of the base amount. We'll then look at these. You can look at these on a chart to get an idea of what has happened over time. So we'll put our oldest year here at the beginning, and then go through our years. So let's look at the trend. We're not necessarily looking at what happened from one year to the next. We're looking at how did these different items that we're looking at, net sales, cost of sales, and operating expenses, how did they change over time? The bottom line is all companies want to keep their net sales increasing, and they want to keep all other expenses controlled or keep them as low as possible while keeping your quality where it needs to be. So the best case scenario, we see the growth in net sales over time. And then you can see here we had correlating increases in our cost of sales and our operating expenses. You can see operating expenses is fairly constant. That seems to be a pretty constant growth in operating sales. But one item I do want to note is our cost of sales. The cost of sales has very carefully followed the change in net sales. Except you'll see in 2011 and 2012, cost of sales lagged a little bit behind, which can be seen as a good thing. Net sales was increasing, but the cost of those sales was not necessarily increasing. But what has happened here as we move towards 2013? All of a sudden, we have the cost of our sales is increasing more quickly than our net sales. So this is kind of an item when you see these changes here and a change in how things are growing compared to one another. It may be something that starting in maybe 2011 or 2012, we should have really gotten an understanding of what's going on. Possibly were these cost of sales decreasing, or, sorry, they weren't decreasing, but they were not increasing as quickly as net sales? Could this be causing problems now? For example, maybe we were buying things that were of cheaper quality, and so that is why our cost of sales was down. Now in 2013, maybe all of a sudden we've realized our problem and we've had to go back and change the way we're making things because we did have things that were of cheaper quality, raw materials or something. Or maybe the people who were working for us were not as skilled. They were new workers, less trained, and so they were costing us less money. However, maybe in 2013 we realized that our people needed more training. So all of a sudden, the cost of our direct labor has increased. Again, these are just different scenarios, but I want you to understand that what we're looking at is how do these things relate? Are they increasing in relation to each other the way that we think that they should? We'll next move into our common size statements. And a common size statement is where we're bringing everything down to a percentage, and we want to understand what different line items are in comparison to a specific base amount. And that's where we were saying sometimes with a common size statement, it's most typical in your balance sheet that you're comparing everything to a base amount that is your total assets. So you want to know, okay, we have $1 million of cash on hand. That seems like a lot of cash on hand, but it's all relative to how large your company is. So the way that we're going to put things on a relative term or a percentage terms to really understand, is that $1 million enough, or is it too little or too much for the size of our company, is by comparing that to what our total assets are. Then, for our income statement, it's most typical that people will compare their common size statements to a base amount of our revenues. So we want to know, okay, this is what our total revenues are, or the total amount that we're selling. Let's look at what are certain specific expenses in comparison to our revenues. And we want to understand whatever we think is the appropriate percentage. We want to check and see that we are actually working and coming up with amounts that are there, because if not, it may be a sign that we need to go back and change things. So let's look at an actual common size balance sheet. Again, with a balance sheet, we're comparing things to our total assets. So all we're doing here is dividing, for example, cash and cash equivalents of $14,259 by our base amount here, which is total assets of $207,000. You can see here the common size percentage is simply whatever item we're analyzing, which on the next slide, that's the cash and cash equivalents, divided by the base amount to look at it as a percentage. And then what we can do is compare that to whatever our common size percentage was for the previous year. So for the current year, we have 6.9% cash and cash equivalents as of total assets. Compared to the previous year, we had 6.1%. And what that's telling us is, as a percentage of the relative size of our company, you can see here the size of our company has increased. So therefore, we would expect to also see an increase in cash and cash equivalents. But what it looks like is we increased more. We actually increased from 6.1% to 6.9%. So that means that in 2013, as a percent of total assets, or as a percent of the overall size of our company, the amount that we're holding as cash and cash equivalents has increased as compared to the previous year. Now, the additional, let's see, that's about 0.8% additional in cash and cash equivalents. That's not necessarily a good or a bad thing. Companies may be holding on to more cash right now because they plan to pay out dividends soon. Or maybe they know they have some specific expenses or things that are going to be coming up. So again, all we're getting at this point is an understanding of the relative size of these different balance sheet amounts compared to the total assets, which helps us have an understanding of the change in the size of our company overall from year to year. We can do the same thing with our income statement, And again, with the income statement here, we can compare to net sales. And all we're doing is, for example, taking our cost of sales here, $106,606, divided by net sales of $170,910. And that tells us the cost of our sales is 62.4% of our net sales. You can see in the previous year the cost of our sales was smaller. So this can be a red flag to look at why, even though, yes, our company did increase its net sales, why did the percent of net sales, the percent of cost of sales compared to net sales increase so significantly? Another way that you can look at this, rather than just using net sales, another common item, you could also use your net income as a base amount. Although I do typically believe net sales is the best. Here we just have an example of what you can do with your common size information. You can create a common size graph. So you can see here, this is just a representation of what we're comparing. So in the case before, the entire piece of the pie would be, for example, our revenue. And this is just showing how is our revenue being used. 62.4% of that revenue goes to cost of sales. 7.7 goes to income taxes and so on. And then whatever is left over, that piece of the pie is our net income. You can also look at this as a bar graph just to get an idea of relatively what are our largest expenses.